Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to continue our conversation from our last episode, where we're going to be talking about factors that impact your financial success. On the last episode, we talked a lot about how obviously the number, the amount of wealth that you have is obviously a factor, but we also ended that episode on kind of a carrot around it's actually not the biggest piece of your financial success. So today we're going to be talking more about the location of your wealth can be more important than the amount of wealth.
Well, not only location, but also true liquidity. And we'll so this is two and three out of the factors for like retirement or financial success. The other, so we've talked so far about size. Today we're going to be talking about location and true liquidity. And the last two that we're going to talk about in upcoming podcasts are the distribution tax status and then the distribution strategy.
And so before we dive into that, Mr. Collins, what are you drinking today?
Today, I am drinking an old classic, the Hofbräuhaus
That's a good
original.
one. Yeah.
So this is it's a good German beer.
Yeah. I'm a big fan of that one. I am not having a beverage today. Not feeling the greatest, so I'm deciding to to abstain for today. But that one's definitely a good one to try out.
For sure.
So let's dive into this, Alex. So when we're talking about location of wealth, I think too often most people have really two buckets of money, and it's really like they have a bit in savings, and I say a bit because it's normally not a lot,
Well, it's
and it can be
especially
too small of amount. Like there's not even an emergency fund there to some degree.
oftentimes it's clients asking us hey, what is the least amount of money that I can
Yep.
have sitting in cash because I don't get a good rate of return? That's changed a little bit with rates having creeped up. Like I'm not having that conversation as often now as I have in the past. I mean, there's the running joke that we have of like banks offering 0 point nothing. Um, we got that from a client who is a banker, by the way. Um, but yeah, it's one of those things where, in general, people have some amount of cash, but not a lot.
And then they've got the second bucket of money is really their retirement account. And it's typically a traditional 401k or IRA, meaning they've put it's pre-tax money that's gone into the account. It grows tax deferred. And when they pull it out past age 59 and a half, all of that money is taxed at ordinary income rates. That's really well. And then there's real estate. But in this conversation, we're not really going to consider real estate, at least a primary home real estate. Now, vacation rentals, that's a different conversation. So you've got these two buckets of money, and that's it. And Alex and I talk about from the standpoint of, okay, so if you're age 35, 40 now, how many more years of work do you want to have, right? Maybe it's 15, 20, 25 years from now. Okay, what could happen over that time period where you might want additional money in life, right? Like, and this is a joke because there's a lot, right? If you've got kids, maybe it's funding their education. Could be putting a new roof on the house. Could be I'm done with this job and I want to start my own business. Right. This isn't the emergency fund conversation. This is just no. This is like this. This is life. We don't just oftentimes if you don't. Oftentimes money is saved and then we use it later on, and we haven't set ourselves up for that liquidity aspect.
I mean, heck, it could be your buddy who sits like three cubicles away is starting a company and offering you to come in on the ground floor, but you have to have cash.
Right. So we talk about the location of wealth. Well, you should have several different buckets of money, and they should be taxed differently because you would want to kind of not be taxed on all of that money if you had to pull it out.
Well, I mean, let's take a step back and talk about some of the characteristics of each of these buckets. And like for ease of simplicity, let's just call it short term, medium term, and long term buckets.
Yes, I'm going to share my screen here. So we normally go through this. So this is something we go through Um, well, maybe we were going to go through this. Yeah. Let me. I'm not getting my OneNote to pull up here, so keep talking about the characteristics, Alex.
Sure. The joys of recording live, right?
Yeah.
Um, so when we talk about each of these different buckets, they're designed to do different things. Our long-term bucket is designed for long time horizons. And so in general, we're looking for things like the most rate of return. This is going to be the most aggressive piece of our portfolio. Now, if we're conservative, it still might be conservative, but it's going to be the most aggressive piece of the portfolio for you and your situation. The reason being is the longer that we have, the more willingness or more appetite we should have for volatility or being aggressive, comparatively speaking. And so Ryan's got his OneNote up, and he's getting us set up for the short term, medium term, and long term buckets. And so we've talked a little bit about long term. Short term is almost the exact opposite. We care a lot less about rate of return. We care a lot more about access. We care a lot more about stability of that asset. This is money that we need. And so when we take a look at it, we're willing to sacrifice rate of return to have a stable asset. Um, and so the liquidity needs to be high. The rate of return as a result is typically lower, and getting access to that money is typically taxable. So, are you ready to take over, Ryan? Or
Yeah. So just kind of catching up here. So as we're going through this, so as Alex just went through, these are very different buckets, right? Your short term bucket is really that's your emergency fund, that's your everyday cash flow, right? Savings, vacations, that kind of stuff, and that needs to be liquid. We're okay with sacrificing the rate of return because we know we're actually going to use this money relatively soon, and that money's taxable. Now, for many years, I think many people forgot that bucket of money was taxable because, to your point that you just said, we weren't getting a return on that money anyway, that zero point 0.0 return that we were getting. Whereas now we're getting a 5% rate of return. And it's really kind of interesting because now if you put a bunch of money sitting in a CD or something like that, now you're actually seeing that money truly is taxable.
well, you're seeing growth for the first time in years, and you're like, "Hey, what do I owe taxes?" Oh yeah.
Right. Then you've got this long-term bucket, and it's not as liquid. Now we can borrow money out of the 401k plans and whatnot, but it's really not as liquid as, say, your savings account. We want a higher rate of return because ideally we're not touching this money, so we're taking more risk with this money, and ideally we're getting some tax benefits today, possibly for deferring the taxes, or maybe we're getting it tax-free when we take it out. If we're taking the Roth, maybe we're paying the taxes today. These are the two buckets of money most Americans have. And
And
as
most
we're
of their money is in that long term bucket.
exactly. Like it's heavily like if there was if this was a scale, I mean, all of their money's sitting in the long term bucket. So, as we were joking before, well, there's this 15, 20, 30-year time horizon where, life happens. And so we often talk about having a midterm bucket. And this bucket is for life, right? This is, as we were just talking about, possibly starting your own business, putting the roof on the house. Like this is the bucket of money that you don't know when you're going to need it, but you need access to it. So one of the characteristics of this bucket is it needs to be liquid.
And we need to have at least some amount of access to it
Correct.
without jumping through major hoops.
The other thing is because we don't know if we're going to touch this money for several years, we want some sort of rate of return. Now, do we want the access or the risk of the rate of return in the long-term bucket? Not as much. So we tend to take maybe a medium risk, if you will, on this bucket of money. And then we also want some tax benefits. And my handwriting is horrible, so hopefully it's coming through enough for you all to understand. this is that bucket where you can touch and go buy real estate if you want to get a vacation property. Again, putting the roof on the house. If you don't have this bucket and you need that, where are you pulling it from? Well, maybe you're doing a HELOC, so you pull it out of your current house if you're putting a roof on your home or something like that. But is that the most efficient use of your money? Maybe, maybe not. It depends on interest rates. How much flexibility do you want through life?
Well, and that you just touched on it, Ryan. It's the whole point and purpose of this account is to create flexibility so that we have choice and flexibility so that when rates are relatively high as they are right now, we don't want to go ahead and refinance the house. We don't even necessarily want to take out a home equity line of credit and pay 7, 8, 9 or more percent as the interest rate. And so ultimately, we wind up with some, needing to have some amount of choice and flexibility as far as like, okay, what, where, when, why. Um, and as you and I have talked about ad nauseum, balance is almost certainly the way to go. And now it's just a matter of like, okay, how much balance do we wind up having currently in our short term, medium term, and long term buckets?
And for those of you asking, well, what's a midterm bucket? What's out of an account? It's really just your standard investment account, just like your 401k, by the way. It's just not locked in a 401k wrapper, meaning it has the tax consequences or the liquidity issues. It's just an account that you're investing stocks, bonds, cash, that kind of aspect in there. And you'll get some tax benefits possibly because if it's designed appropriately, maybe you can get some long-term capital. You'll pay long-term capital gains tax over short-term or ordinary income tax rates. And then the other account that could go into this is forms of permanent life insurance, whole life insurance. Now, again, life insurance is life insurance first, but these permanent life insurance products, some of them offer some cash value, which is an asset that grows tax deferred, and you could get access to it tax free. So those are two different style of accounts to do. Now, the risk associated with the investment account depends on how many stocks you want versus bonds or cash, right? So that you still have that risk tolerance to take into effect. If we're comparing this investment account to say your long-term account, maybe you're in that 80-20, 90-10 in your 401k. With this midterm bucket, you're not going to want to take that same type of risk profile because again, this is money you might have to touch and not realize and not know the year that you're going to do it. So you're normally going to take a little bit less risk with this style of investment account.
Well, and here's the thing, Ryan, is that like the midterm bucket is so nebulous. It
Yeah.
essentially starts right at the end of the short term and goes right up to the end of the long term. And so we might wind up with having two different accounts or three different accounts that fit into this midterm bucket, but one where we've got designs on buying a house or a rental house or a second home or whatever in 2 to 3 years, and then another style of account we're looking at retirement for, or not retirement, but college for the kids in 15 to 20 years. Like, okay, we've got different time horizons and different risk tolerances and different goals for that money, and so we're going to manage it differently as a result.
And we're going to get to this later on, where when you've got these different buckets of money that are taxed differently, now there's different tax strategies that you can employ when you go to pull this money out, either pre-retirement or specifically in retirement, which we're going to get to in our next episode. So location of your money is key because again, we don't live life on a spreadsheet. You don't know when you're going to want more money for different things that might happen. So we want that midterm bucket. Now, this transitions into, and we've already brought this up already in terms of liquidity. How much of your money are you going to want in the market versus out of the market when you're getting close to retirement? And so Alice is going to kind of take over here and take us through an example of what we mean by true liquidity.
Well, so that short-term account, chances are we want most of, if not all of that money out of the market because safety and taking less risk is so critically important. Whereas if we're looking at 20, 30 years before retirement, we want most of that money in the market, whether it's the stock market, the bond market, the real estate market, whatever. where the value is going to fluctuate based on the opinion of the market as opposed to being something that's known. Um, but yeah, let's go ahead and take a look here um, at, um, and hopefully I haven't timed out. Yeah, cool. So this is inside of Living balance sheet. We've got a sample client here that we're looking at. So it's not real data, real information, but it gives you an idea. So if we're looking at a 20-year study period and we're starting in the year 2000, let's just use $1 million account. And when we get to retirement, let's say that we want to have balance. So we've got a 50-50 approach. We're going to try and take $40,000 a year. We're going to increase that at 3%. Let's live in a world with about 30% tax rate. Let's say that we've got a 1% investment fee. Um, and now over here in the variable plus true liquidity, let's start out with 700,000. We're going to use a 75-25 allocation. We're going to take a same $40,000 withdrawal, same 3% increase. And now we've got 300 grand sitting over here in this true liquidity account. We're going to give this true liquidity account a 4% rate of return. Um, and, some people might say, oh, that's high, or other people might say, oh, that's low. We're just trying to give an example of something that we know exists where we can get a 4% rate of return on either a guaranteed or virtually guaranteed basis over a long time horizon, like a 20-year study period.
So real quick, Alex just threw a bunch of numbers out there. I want to make sure we're explaining this calculator. So Alex has got really two different, let's just call them two different people. One person has decided, I want my $1 million in a 50-50 allocation, 50% stocks, 50% bonds, and they're taking a distribution of 40 grand a year with inflation. Then you've got person B who decided, I want 700,000 in the stock market, but I want that 700,000 in a 75-25 allocation, 75% stocks, 25% bonds, and the other 300,000. So same $1 million, but the other 300,000 that's left over is in a liquid bucket getting a 4% return. And so what Alex is going to go through and analyze here is how does this really work out utilizing like the money in the market, it's going to go up and it's going to go down. Well, when you're in retirement, you're going to want an income stream. Like you don't have a choice. So how does that play out over time here?
Yeah, and so if we've got our $1 million and we're taking our 4% withdrawal rate, this is going to equal 40K a year. And if we need all $1 million to go ahead and create that $40,000 a year, if we start slicing off a piece to create liquidity, let's say we try and slice off 100 grand because we've got like a really big medical expense, or need a new roof, or something has caused us to need 100 grand. Well, at that point, we now no longer have $1 million. We've only got 900 grand. And if we're using the 4% distribution method, now we no longer have 40,000. We only have 36,000. And so that creates a little bit of a problem. And so ultimately what this is saying is that if we got $1 million and we're using the 4% distribution method and we need that $40,000 income stream, we don't have any liquidity. However, if we've got our same $1 million and we're using a different distribution method where we're able to go ahead and carve off 700 grand, and then we've got 300 grand sitting here in a true liquidity account, and people are probably scratching their heads saying, Alex, what the heck is a true liquidity account? We'll get to that here in a minute. Um, but for right now, let's just assume that that's cash and cash equivalents. If we're able to go ahead and create $40,000 a year from this 700 grand, and the way that we're able to do this is by spending this to zero over that 20 or 30-year time period. Now we've got access to carve off that 100 grand from our true liquidity account because it's not required to create the same cash flow. And so we've got more flexibility. Now, what the true liquidity calculator that we're going to walk through is designed to do is, okay, how do we quantify that and how do we know that it works? So in this example, we're looking at starting in the year 2000. And some of you are probably already thinking to yourself or saying, oh, well, Alex is just cherry picking timeframes. We'll go look at some other timeframes here if we've got time here in a minute. The way in which this works is we've got all $1 million invested in that 50-50 allocation. Whenever we have a positive rate of return, we're pulling our 40 grand out of the market. Whenever we have a negative rate of return, we're pulling the $40,000 plus inflation out of our market portfolio because we only have one bucket of money. And so ultimately, at the end, we are left with about $255,000. So we've spent almost $750,000, and we're seeing our account crater. This account is not going to last much longer given what our circumstances are. We're now trying to pull $70,000 a year, which is almost a third of the portfolio remaining. Over here, where we're looking at variable plus true liquidity, we've got $700,000 sitting in the variable account, and that's a 75% stock, 25% bond mix. And we've got another $300,000 sitting in cash equivalents, and this is getting our 4% rate of return. If the market is down, we're not pulling it out of our market portfolio, we're pulling it out of our true liquidity portfolio. If the market is up, we're pulling it out of the market side of the portfolio, not the true liquidity. So you can see in 2000, 2001, and 2002, we're pulling it out of the true liquidity side. And then the next couple of years, we're pulling it out of the market side. Now we've got a down market, we pull it out of the true liquidity side. So you can see how this works. And at the end, we wind up with an extra amount of money. In this example, $20,000. You might say, oh, $20,000, that's not a whole lot. But at the same time, we're also taking dramatically less risk. So, we wound up having $300,000 that was sitting in cash. And so we've actually got more of our portfolio sitting in fixed income, even if we assume that cash and bonds have the same risk. Now, if you go back to 2022 and ask anybody who had a bond portfolio if there was more risk in cash or more risk in bonds, they're going to tell you there was a whole heck of a lot more risk in bonds because bonds were down 15% that year. Cash was up. And so when we're comparing these things, we need to go ahead and take a look and say, not only do we have $20,000 more, but we actually also took less risk.
Well, and I want to take that to another level here. Put yourself in this person's shoes, or listeners here, right? The person on the left had $1 million they put in that 50-50 portfolio and they've been taking 40 grand out. If your first 3 years in retirement, the rates of return were all negative and you're seeing your account dwindle like that, right? At the end of year 3, the account is worth $800,000. So you've lost $200,000, not lost, but the account is worth $200,000 less than what it started. Your third year into retirement, are you at all getting emotional about your money? I'm going to guess yes.
To be fair, we're also sitting at like 750,000 over in the on the other side, but at the same time, it's all come out of the liquidity side. The return, we're actually taking more risk on the portfolio. So as a whole, we're still looking at it going, okay, we're okay, but at the same time, we wind up with less risk overall.
Yeah. And that's the pieces. You have buckets of money that they're not correlated with one another, which allows for that flexibility and hopefully a less emotional grievances when it comes to the stock market up and down in retirement at that time.
And now somebody might say, Alex, you're cherry picking time. The market did terribly during the early 2000s. Okay, let's look at the early 80s. Now, the one thing that we need to adjust here is what were interest rates doing in the early 80s, right?
They were not low.
They were not low. So our true liquidity needs to be adjusted. And we were seeing guaranteed rates of return of 7% plus. This is an average over the next 20 years. In the early 80s, these were actually double digit, but let's just use 7% for it for like this is a low ball number. And when we start taking a look at that, Now we don't see negative rates of return until 1990, and we wind up with $2.5 million of money left over at the end of our time period. Well, okay, not a problem. We're happy. We're jumping up and down. Well, again, we could have had 2.7 million, and we would have again taken on less risk because our true liquidity account is building, and we've got over $1 million now in our true liquidity account. So even though we're putting money into cash and cash equivalents, which don't get as good of a rate of return, we're still looking at having more money overall while taking on less risk.
So the point of this exercise is, today's conversation is about location of your wealth, and we were talking about the different buckets, but it's also how much of your money is in the market versus out of the market, and the liquidity, in our definition, true liquidity of that helps you be more efficient and really live the life you want, mitigating the risk rather than really relying upon a rate of return and the volatility in the market.
One of the questions that we'll ask some of our clients is, okay, Ryan, how much of your money do you want sitting in the market the next time there's a downturn?
None. At least most of the time we get none. Yeah.
Yeah. Like most of the time we get that answer. We're like, hey, am I allowed to pick none? And then like we then followed up with the question like, okay, well, is that realistic to do? And like 95% of the time clients are like, no, it's not realistic because we still have, a 10, 15, 20-year time horizon before retirement. Okay, well, got it. Well, how long, like if this was at retirement, how long do you want to live in retirement? And like 20, 30 years? Got it. So even when we get to retirement, we still have a long time horizon, right? Oh, I guess I'd never thought about it that way. Yeah. So like there's no way to not have money in the market. Now the goal is to go ahead and when we get to retirement, minimize the impact that the market is going to have on the success or failure of our portfolio and our plan.
So I know many of you are not in retirement, right? Most of our listeners are not at that pre-retirement age, pre-retirement meaning like, 60 and above. However, you're making decisions of where to put money today. And so hopefully with this information, it allows you to think differently around where to be putting money for the most efficient use today and tomorrow.
Wait. So Ryan, I can't just like move $300,000 at retirement into a true liquidity account?
Well, if you want the risk of 2022 being there and your money being down 20% at the time that you want to do that, sure. Yeah. Most people we talk to, they say no to that.
And so again, that's why we're talking to folks that are in their 30s, 40s, and 50s, is because you still have a long enough roadway and ramp to go ahead and make decisions with the location of where your money is on your balance sheet to be able to make these changes without having to try and time the market or get lucky and not run into a down market at the wrong time.
Yep. Which takes us to the question of the day, Mr. Collins.
Our question today is, do you have a midterm bucket? And if so, what is it that you have in your midterm bucket?
So head over to beerandmoney.net, and if you click on today's episode, you'll see the video as well of what we discussed today. I know many of our listeners listen to it in the car. Make sure you check out the videos. We did the visual side of it today as well. Answer the question, or if you have questions from today's episode, that's a great way to reach out to us at the Contact Us spot at the top. Look, we started this podcast to help you think differently about your money so that you can actually spend time with your family, not stress over money, and enjoy that time. We hope this episode is valuable for you. And as always, Mr. Collins,
cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or quantified financial partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Pinpoint number 2024-177345, expiration June 2026.